All right, looks like everyone's just about joining us, so we'll get started. My name is Jessica Cantone, and I am the Assistant Director of Alumni and Parent Engagement here at Bryant. And on behalf of the Office of Alumni and Parent Engagement, I want to welcome you all to our webinar today, which is Long-Term Care Insurance. And I want to let you all know that we'll be opening up the floor for questions at the end of the webinar today. However, you do have that chat feature located at the bottom of your screen on Zoom. So feel free to send in chat questions for Linda throughout the presentation. If you prefer to ask a question directly to her, you can send that to her. Or if you prefer to ask a question anonymously, you can send that chat question directly to me, again, Jessica Cantone, and I'll ask it to Linda anonymously. And so without further ado, I want to introduce Linda Tallheimer, who again is going to be talking with us about long-term care insurance. So Linda, please take it away.
Well, thank you. I'm so excited to be here to talk to all of you. Just a little bit about me. I am an occupational therapist. I have my master's in healthcare administration. I worked in healthcare for 16 years, and my last health setting was long-term care in a nursing home. And when I saw the changes in healthcare and I no longer knew how to manage a department without significant effort, ethically and profitably, I learned about long-term care insurance. And I thought, oh, what a great concept. And so I learned all about it. I've now been doing long-term care for over 20 years. I am extremely passionate about it, which I'm sure you will sense my passion as I talk. And I want you all to know that I'm trying to squeeze an awful lot of information in a very short period of time. So I know you will have questions, any questions that I can't answer on this presentation. Know that I can reach out to you after the presentation and answer all of your questions, because I do want to make sure that I answer all of them. All right, so let me just change this screen a little bit. Okay, so the whole concept of today is to really understand, is it better to have and not need, or is it better to need and not have? So in order to do that, we need to do this very logically, right? We need to define long-term care. We need to evaluate the risk of long-term care. We need to then evaluate the cost of care and evaluate the impact of that cost and risk, and then evaluate and compare the cost of insurance. And then I can tell you a few stories and open it up for questions. So let's start off with the definition of long-term care. Long-term care is when you need help with 2 of 6 daily living skills. So that's bathing, dressing, toileting, continence, transferring, or feeding oneself, or a severe cognitive impairment. Now, what is a severe cognitive impairment? Now, as people age, we are usually not surprised when people have some impairment with their memory. But that is not necessarily long-term care. Long-term care is when you can no longer figure out what your sticky notes are reminding you to do, and when you're looking at a pill box and you're not even sure what day of the week it is. Okay, so all of us will hopefully age. Many of us will have some impairments, and when they become significant, in which you need help, a significant amount of help with your daily living skills or supervision for cognitive impairment, is when long-term care actually begins. So now let's look at the risk of care. And I always start with the risk of care and the concept of, would you be surprised if you lived into your 80s or 90s? And most of us would not be surprised, right? In fact, we're not even surprised when people get to 100 anymore. I mean, we get excited, but we're really not surprised. And we're certainly not surprised when an 80 or 90-year-old needs some home care or some assisted living or even a nursing home. Although, for the sake of this presentation, my whole goal today is to really help you stay out of nursing homes. That nursing homes become very challenging places to live, and that the vast majority of people will want to stay in their own homes or go to really nice quality assisted living settings or continuing care communities. And if a nursing home is actually needed, you want to go to a private nursing home, which is much, much more expensive. So now, one of the questions that will come up over and over in your minds today that I want you to be aware of is that every time I talk about long-term care cost and I talk about the cost of insurance, what's going to pop in your mind is, what if I never need it? And it's certainly a legitimate question, but which is why I started with this risk question, which is, would you be surprised? So if you're not surprised that you're going to live into old age, and you're not surprised when other people who are 80 or 90 need some care, every time that thought that pops into your head that says, what if I never need it? I want you to ask yourself the other very important question, which is, what if I do? Because the greatest predictor of mortality and morbidity is medical advances and lifestyle. It's actually not genetics. There are some very specific genetics that do lead us to long-term changes, but the vast majority of us will live into old age because of better lifestyles and better medical care. So now, dementia has become one of the biggest risks of aging. And so we talked about that you can enter into long-term care for 2 out of the 6 daily living skills. And that's what most people used long-term care for in the past, right? So people had spinal stenosis, and they had arthritis, and they had strokes, and all those things entered people into claim on a physical level. Today, a much larger proportion of people enter into claim because of dementia. And it's a catch-22 because we eat well, we live into old age. And what do we look forward to? Over the age of 85, 50% of those people who are over 85 today have dementia. It's not a future statistic. It is a today statistic. And 35% of those people have moderate dementia, which means they require supervision, 24-hour supervision, because we don't know when that disorientation is going to take place. And the greatest predictor of dementia is over the age of 85, age itself. So an 86-year-old is more likely to have dementia than an 85-year-old, an 87 more than an 86-year-old. More than disease itself, age is going to be the greatest predictor of dementia. So what is the probability of needing long-term care? What do you think is the probability of needing long-term care? Well, 70% of the general population will need long-term care as defined, as we just did. However, only 40% of insureds will need long-term care past age 65. Now, why is that different? The people who get insurance are going to be healthier and wealthier, which tends to mean they have better health care. So 40% will need care over the age of 65. 48% of insureds who live past 85 will need long-term care. So again, when that little question pops up in your mind, what if I never need it, comes into place, recognize you're talking about a 1 in 2 risk. What if I do has to be the other question that's very important in this decision-making process. So what do you think the average utilization is for long-term care? So we know what the probability is, but how long do people use long-term care? Well, for a male, it's 2.2 years, a female 3.7, and those are really for those physical ailments that people enter into long-term care, disease and illness. But how about for dementia? It's an average of 6 years, regardless of gender. And so what we're going to see is we're going to see a lot more males using long-term care for longer periods of time because our male population is getting healthier. They're eating right, they're exercising, they're retiring earlier, they're not as stressed because the responsibilities of maintaining family financials is being spread between couples. So I fully expect, and we're already seeing, that males are living into older ages, and therefore they will be using longer long-term care benefits as well. So now let's talk about the cost of long-term care. Now the cost of long-term care just skyrocketed this year with COVID. So I used to say the cost of care was somewhere on average between $25 and $30 an hour, and I will be using the next slide at about $30 an hour. But I want you to appreciate that the cost of care is actually much higher than that. To bring someone into your home, you're talking anywhere from $34 to $38 an hour for 4 hours of care. I was just talking to another care provider today and asked him what his rates were, and they're at $34.50. So, and you don't bring in an aide for less than 4 hours of care. So if you need 1 hour of care, you're paying for 4 hours of care. So the cost of home care is significantly higher. Under COVID, people are actually putting additional costs on where it's maybe $38 an hour for standard care. If you have COVID, they're charging $55 an hour, and you have to pay for 2 days after care stops. so that the caregiver is paid for until she can take testing and show that she has not caught COVID. So some home care agencies are actually requiring up to 8 hours of long-term care for a single hour to walk into a home. So things have gone really crazy under COVID. Now, assisted living settings average about $6,000 to $6,800 on average, but if it's a dementia setting, they usually start around $7,500 and go up from there. And it's important to realize that an assisted living is a very, very valuable place, because as soon as you need nighttime care, you're looking at a very, very expensive home care setting. So assisted living becomes much more cost effective. But the more you have, the more you will spend, and the greater your quality of care. So if you are spending $6,800 in an assisted living, it's likely that if you need care every single morning and you want a shower before you go to breakfast, that you'll hire a private aide to come in every morning, so that if you want to be up at 7:30, you have a private aide come in, they bathe you, they dress you, and they get you off to breakfast. And then you rely on the assisted living for all of those other tasks that go on during the day, and to get you back to bed at night, and if you need care during the evening. So when calculating for the cost of care, it's important to think it's not just about the cost of the assisted living. It may be those additional costs that you would want to have that higher quality of care when you need care. So let's talk about the future cost of care. And this is going to be overwhelming and stressful. It is much more than a college education, which we thought couldn't be surpassed, and it is surpassed in long-term care. So even if we start with $30 an hour and we have a 4-hour minimum, that's $120 a day, $3,600 a month. And if you need AM and PM care, you're now talking about $7,200 a month. And this is growing at 3% a year. At that point, many people will move into the assisted living setting, which is running at about $6,800 a month, but it's increasing at 5% compound. So if we just take an average between the two of them, we say, let's say we have a $7,000 a month cost growing at 4% for the next 30 years, we're now talking about $22,700 a month. Now, some of you are going to say, well, there's just no way I can afford this. I mean, this is just ridiculous. So what I'm trying to show you is this is the high quality of care. So what ends up happening is if you don't have this kind of money, after your spend down of your assets, you use the government, of course, but during this process, your choices are just not as great. So you won't go to the nice average setting, you'll go to the median assisted living, or instead of having 8 hours of care, you'll have 4 hours of care, and your family will be burdened with the extra care. I mean, so the reality is that you will have care. It's just a question of the quality and the choices and the impact on the people that you really care about and who care about you. So then if we look at the average duration of long-term care, we said it was 2.2 years for males, 3.7 for females, and 6 for a dementia. And if we extrapolate that 22,700, we're looking at close to 600,000 for a male, $1 million for a female, 1.6 million between the two for one who needs dementia. So now someone asked the question, is there a liquid net worth amount that long-term care is no longer required? And the answer is, required is a relative term. So we do a lot of things not because we need to, but because we want to. And that goes for very high net worth people. So high net worth people don't have to work anymore, right? So if you have 25 million, you don't have to work. And you don't even have to invest in the stock market, because if you never made any more money, you could certainly live on 25 million. But people who have lots of money still work, and people who have lots of money still invest, and these people still don't like a bear market. And a long-term care is a bear market. It is a market dropping with no end in sight, no potential to ever recover. And in that moment that that person needs care, we don't know how much it's going to cost and how long it's going to last. And so it's a very scary situation. Now, for a wealthy person, it is a choice. And in fact, just this month, I had a person who well over that $25 million mark, who spent $900,000 on a long-term care policy. And they did so, this couple, because they wanted to know that when they needed care, they would want 24-hour, 3 awake shifts caring for them in their home. And that's $22,000 a month today, growing at 3% compound. So they bought themselves that full coverage of long-term care so that in the future, their $900,000 of premium would represent between $7 or $8 million in long-term care coverage. So did they need to buy long-term care? Could they self-insure? Absolutely. They had 7 or 8 million, even to pay for the highest level of quality of care. Did they choose to leverage their money and purchase a long-term care policy? Absolutely. So let's look at more realistic retirement portfolio. And here we're looking at somebody who has $2 million in their retirement. And then we say, well, how is that going to work out with long-term care? So over here on the side, we see that long-term care, I have in a little circle. And if we average $6,800 a month for 6 years, in today's dollars, that's close to $500,000. So if we were going to say, I want to plan to 100% cover my long-term care, and I'm going to be my own insurance policy, then that means that instead of 2 million, you only have 1.5 million, because 0.5 million needs to be moved over to your long-term care account to grow to support your long-term care when you should need it. And remember that this money in your retirement account, for most people, a good portion of that is IRA money, which means that it will be taxed. So the question we're really asking today is, can you purchase a long-term care policy that can leverage your retirement savings so you don't have to put aside $500,000 today, or $250,000, or whatever it is that you want to allocate for long-term care? Is there a better way of doing it than just keeping it in your retirement account and hoping that you don't need it? So let's look at a long-term care policy. So what I did is, this is a long-term care policy. This is for two 55-year-olds. And there was a question in terms of what constitutes a couple. A couple are two people in a committed relationship, not married to anyone else, of the same generation, sharing household expenses. So that is a couple, and then you're eligible for couples discount. Women are typically 35% more than men in long-term care in costs. However, this policy specifically that I'm showing you is a really exciting policy for same gender couples, because they only look at the gender of one of the couples and one of the couple, and the other one is non-gender specific. So this is an especially functional policy for two women gender couples. So because they're usually so much higher priced than males. So let's look at, now in this case, I have underwritten them at actually what's considered a select rate. This is a very smart company, and nobody likes to be called select or standard. So they actually have a preferred best rating, and then they have a preferred rating. So the preferred rating is like a select or a standard rating. And it means that, you know, a lot of people will have high blood pressure or high cholesterol. They may have anxiety or depression. They may have had a knee replacement or a hip replacement. But as long as everything is stable, insurance companies like stability. Okay, so as long as everything is stable, then this is the rate at which two 55-year-olds would have on their long-term care policy. So what I started with was $250 a day, growing at 3% compound, and 3 years each, so that we would hit that statistical risk of 6 years for one person and still have 3 for the survivor. And a policy like this would cost $5,776 a year. And in this policy, I just want to show that traditional policies can be paid in a 10-pay or a single pay. So that you could pay $57.76 a year, or you could pay just under $15,000 over 10 years, or you could pay $145,000 and be done with it in a lump sum. little details just to know that there are options within these types of policies. But let's look at specifically at the cost value of insurance. So a 55-year-old couple spends $5,776. Each couple will have $273,750 each in their pool. If one of them uses up all of their 3 years, they then go into the extra 3-year pool and they can use up to those last 3 years, and they would have 3 for their spouse. The total value on day one is $821,250. It's growing at 3% compound. So at age 85, this 55-year-old couple, 30 years later, their daily benefit is now $607 a day. So that's an annual benefit of $221,000 and a total benefit of close to $2 million. Now, some of you are going to think, well, what if I'm older, right? Some of you will be thinking, what if I'm younger? So I just wanted to show a 65-year-old couple. I would probably, depending on income levels, if I wanted to keep it at about the same rate, so here this was 57.76 and this is 57.42, I might drop it down from 3 years each to 2 years each, so that's 6 years between the two of you, and I might have dropped down from $250 to $200 a day. Now we only have 20 years to increase this policy because we're going from 65 to 85. Your daily benefit at age 85 will be $361, with annually at $131, almost close to $132,000, and your total benefit close to $800,000. So now the question is, what if instead of buying a long-term care policy, I invested this money on my own, right? Because that's ultimately the question. Should I be doing this myself, or should I let insurance do it? So this one will help you look at that. So let's say this is the 55-year-old couple. They took $5,776 a year. They invested for 30 years, and let's say they got a 5% rate of return every single year for 30 years, no ups, no downs, beautifully stable for 30 years, guaranteed. At the end of that 30 years, they would have $400,000 and close to $28,000. Now, if this was a taxable account, this couple would be taxed on close to half of the money in that pool, actually a little more than half the money in that pool. If they had purchased that long-term care policy with this $5,776, they would have close to $2 million, and all of it would be tax-free. So certainly there is significant benefit to having this type of long-term care policy. And let's look at it just for a 65-year-old and see if that would be a cost benefit, because now we're talking about a little bit less leveraged policy. So now we're putting in the 5742. It's only 20 years. They would have $215,000 rounded up, of which $94,000 would be taxable. And if they had a long-term care policy, they would have close to $800,000 of tax-free dollars. So again, hugely leveraged, more than 4 times the benefit in a long-term care policy. And that's given that you could guarantee that you would have 5% every year, and the year in which you took your money was an up year on the market. But there's, yeah, I feel like an advertisement, but there's more. All right, let's look. There are tax incentives for long-term care premiums on traditional policies and on a few of the hybrids, on portions of the hybrids. So if you have an MSA or an HSA savings account aligned with your health insurance, you can take age-based deductions. So if you're over 50 years old, you can be taking about a $1,600 deduction as a couple, $3,200. And if you're over 65, you can be taking close to $9,000 as a couple. And I should clarify, I am not a CPA. I am not giving tax advice. All right, so if you are an independent business owner, a partnership, or an S Corp, it's the same concept as the MSAs and the HSAs with age-based deductions. Now, if you are a C Corp, you can potentially take the entire deduction as a business health expense, because this is considered a health premium, like health insurance, and so C Corps businesses can take these as deductions. And if you own a business and you're buying it for an employee within your business, then those are also situations in which you're not limited by the age-based deductions. And I should say that the benefit is always going to be tax-free. So regardless of these traditional policies, that even if you take the entire premium as a deduction, the benefit can be received tax-free. Now, next question, does the government help? Well, Medicaid, and I always love this, Medicaid is different from Medicare. Medicare is medical care. Medicaid is financial aid. And if you look at those last three letters, when all your investments are depleted. Okay, so it is a program for the poor. It is a loan, not a gift. So there is a spend down when you want the government to help. Generally speaking, and this varies from state to state, but generally speaking, it's about $126,000 for a spouse and $2,000 for an individual. And once you go on Medicaid, there will be a lien placed upon your home. If the home is sold, that money goes back to pay for Medicaid expenses, puts you on private pay until you're spent down again. If someone is living in the house, like a spouse, then the lien stays on the house. When that person dies, that lien stays on. And when the house is sold, ultimately that half of the house would be allocated to refund Medicaid. Now in Massachusetts, it's the only state in the country that has this. Massachusetts has what's called a Mass Health Lien Law. And what it says is that if you have a very basic long-term care policy, $125 a day, 2 years of benefit, you can protect up to $870,000 in a primary home. So that means that you could go on Medicaid, a lien will be placed on your home, but when you die, the lien is lifted and all $870,000 or up to that value in your home is left to your heirs. So I just want to show you how inexpensive just a minimal policy to meet Mass Health Lien would be. If you just go with no inflation and meet the very basics of the law, it would only cost $84 a month for a couple, a 55-year-old couple, less than $1,000, just a little over $1,000 a year. If you added inflation protection, it would go up, oops, I've got my screen blocked, to just under $2,000 a year. And if you wanted to add that third pool of benefits, it would go up to just under $2,600 a year. So very cost effective. You know, this is the most basics of policies and very easy to know that you can protect the value of your home. Now in other states, they're called partnership states. Rhode Island is a partnership state. And what that says is that if you buy a qualified long-term care policy, that your estate is protected dollar for dollar. And what this means is that where there is a typical spend down of about $126,000 or $2,000 for an individual, the money in your long-term care policy is added to that number. So let's say you have $1 million of long-term care. And so the insurance company has paid you $1 million in long-term care benefit. And now you're done with your long-term care policy and you're spending down your assets. You can literally go onto Medicaid benefits with $1 million and $126,000 and go on to Medicaid. Or if you're by yourself, you could go on with $1 million, $2,000 respectively. You are allowed to give away or use this money protected by the long-term care policy as you receive the protection. So for every month you receive $6,000 from your long-term care policy, you just protected $6,000 from your estate and you can go out and spend it. Now, this gives you tremendous flexibility. I mean, you can continue, let's say you spent down your long-term care policy, and even though you have $1 million in protection, you may still choose to continue to use your private funds to stay in your private facility. But it gives you the flexibility to say that if I really wanted to leave something to my heirs, you could choose to go to a Medicaid facility, such as a nursing home, and you'd never want to go to a nursing home without supports. So you just use your private funds to, say, bring in a private care provider 4 hours a day, 7 days a week, which is going to be much less expensive than an assisted living, right? So you bring in your 4 hours and then you've got somebody to provide a quality environment within the assisted living so that it's manageable. And then you can ensure that your heirs can have an estate, or that if it's less than $1 million and your long-term care policy is $300,000, for example, and you're really, just trying to maximize whatever you can guarantee that you would have a higher quality of care because you can co-fund with Medicaid and give yourself some private care within that facility. So I'm going to tell you a story. And this is a semi-true story. I'm not giving you any names and not going to tell you exactly, but it's very, very common and it's based on a true story. So there was a couple, about 15 years ago, they were sat down with a long-term care insurance person and learned all about long-term care. And they said, gosh, that seems awfully expensive. And they said, you know what, we've got $1.5 million in the bank in retirement, and we've got our home all paid off. We can fund long-term care ourselves. And 10 years later, 15 years later, he was diagnosed with Parkinson's, and he continued to get worse. And the wife cared for him until he got sick and he went to the hospital and he came back home and he had some home care. And then they recommended that she get some help. You know, it's time, you know, this is too much for you. You know, just bring in someone 3 days a week to get him up in the morning and bathed and dressed and going. Take a break. You go exercise, you go meet with some friends, you go to a support group. Life will be better and you'll be able to keep him home longer if you're healthier. And so she did this. And she said it was wonderful. It was absolutely wonderful. And in fact, it was so wonderful, she decided to increase home care. And then a couple months later, I got a call from her, and she said, I can't take it anymore. He needs to go to the hospital. He needs to go to a nursing home. And I'm like, what happened? It was so perfect. You were doing so well. She says, I got the bill. Oh my gosh, home care is so expensive. There was no way I could keep that up. I canceled it. So for the last month, I've been doing my care myself, and I just can't do it anymore. And in that moment, they started their spend down. And all of her goals, their goals, suddenly changed because their retirement portfolio was about to be decimated. And I couldn't even be sure that there was going to be enough for her care. The house would likely have to be sold and to provide for her care. And whether or not there would be any money left over for her heirs would be questionable, based on whether or not how long he stayed in care or how long she would stay in care. And you don't even know how to even think about it. Is it better to say, oh, I hope he lives a long time in care, or he hopes a little time? I mean, it's just not a good situation. It's a lose-lose situation in that situation. So let me ask you, do you think when this couple made the decision to self-fund long-term care, they were saying to themselves, I want to pay dollar for after-tax dollar for long-term care? Do you think they said, gee, I don't want to leverage my money? Do you think they said, well, I would much rather spend 4 to 5 times for the cost of long-term care? Or do you think they said, you know, I just don't want to have any catastrophic protection? Of course not. What they were saying was, I don't believe I will need long-term care. So let's talk a little bit about the value of hybrid products. Hybrid products have return of premium. So for people who just can't get that down because there's this little aching in their head that says, I just don't know if I'm going to need long-term care, these products have a return of premium on them so that if you don't use the money is returned to the estate. They actually have some really nice options. They have cash, which makes it really easy. So if you have family that you want to pay to provide care, or you just don't want to deal with any kind of reimbursement, they're a very easy policy to use. They also have residual death benefits. So even if you use up the entire life aspect of the policy, there are still residual death benefits. They tend to be more flexible on international benefits. And they also, very, very importantly, are more flexible in their underwriting. So people who may not qualify for a traditional policy may qualify for a hybrid. Let's talk a little bit about impaired underwriting. So if people don't qualify for a traditional product or for a hybrid product, there are annuity hybrids that are a little bit, much more flexible in long-term care. And there are, if it's a physical illness, physical impairments, a life with a chronic illness rider could work. Again, if it's like a stroke or if it's heart related, if it's illness related, that's not going to be an effective alternative to impaired underwriting. Home care contracts. So there are home care contracts that basically say that as long as you are independent in all of your daily living, your community living skills, and you're still driving, you qualify for a home care contract. So different rules because it's not technically long-term care insurance. It is a home care contract that provides home care benefits. So this is a great contract for somebody who suddenly gets diagnosed with dementia. So they still might be driving, but you know that it's just around the corner before they may need care. Somebody who's had a stroke who recovers, but they're independent, but they're much more likely to have that second stroke. People with MS who would not qualify for a traditional policy can get home care contracts. And in some states, there is something called short-term care. Unfortunately, it's not in the Northeast, but if anyone here is planning to retire in the South or in the Midwest, their short-term, long-term care products are much more flexible. So in summary, long-term care from a financial perspective provides an identifiable pool to fund care. So there is no question to any of your heirs or to each other to say, when long-term care happens, it's like, oh my gosh, can we afford this? Well, of course you can afford it because you've already allocated that fund. So it takes away that stress. It gives you more money to spend in retirement. So instead of having to allocate, whatever it is you decide that you want to allocate for long-term care, instead of having that $500,000 out of your retirement pool, maybe you only need to save $250 because it's being funded by a long-term care policy. It leverages your long-term care so you have more when you need it. So if you have money allocated for long-term care and you need long-term care, and your long-term care policy is paying for 70% of it, you don't mind spending that other 30%. In fact, you may not even mind spending another 50% because at that point, it doesn't feel like much coming out of your retirement account. It eliminates the stress of what accounts to liquidate during a crisis. Which funds do you liquidate? And what happens if it's a down market? And what is the impact on qualified dollars when you take them out in large amounts? And it maintains the lifestyle for the healthy spouse so that they don't have to worry that all this money is suddenly going to change their lifestyle. And of course, it provides that catastrophic protection on being able to leave an inheritance or to extend care. But I want people to understand it's not just about the money. It gives direction to the family. It says, I don't expect you to be my caregiver. And this is very, very important because kids, let's face it, many people in this group have paid for their kids' college educations and taken really good care of their children. And you've taken care of each other as couples, for those of you who are couples in this group. So when something happens, the other person will think, I'm supposed to take care of my parent. And so they will impact their relationships with their spouses, with their children, and with their jobs to provide that care, because that's what they feel they're supposed to do. When you have a long-term care policy, you told your children in a very clear way, I don't expect you to be my caregiver. I already paid to have someone else be my caregiver. Trust me, there are so many things left for the family to be able to do for you. That's not going to be a problem. Minimizing conflicts between siblings regarding responsibilities and finances. Some children are going to be very, very successful and they don't need your money. There are going to be other children that are relying on that inheritance, and it can destroy relationships. It also can impact just when one person lives close and one person lives far away. The one in California says, hey, listen, you live in the East Coast, you live close to mom and dad, obviously you're the one who should be providing the care. It may be the single sibling. I'm married, I have kids, I don't have time for this, you're single, you can do this. Not realizing the impact on that single child's ability to actually find someone, a partner for themselves. It provides opportunity for better care settings and additional caregivers. If everything's coming out of the retirement pool, you tend to be a little bit more tight, but when it's already been allocated, you can reach into your account more comfortably and say, oh, I don't mind supplementing the care that's already being provided. And unfortunately, the other concern is that knowing that you've already looked into long-term care, it does create a feeling of, uh-oh, what I could have had. So I'm just going there. So I was going to say, we already went through that. And so now I'm really just open for questions. I'm trying to think if there's any question I missed. Yeah, somebody had asked me, what is the best time to get long-term care at what age? And I don't believe there is an age. I believe there is a financial status. So because in any one moment, if we have not learned this year, it's that we are healthy until we are not. For some insurance companies, like that insurance product that I showed you up first, it's a 6-month wait from COVID with no symptoms. So if somebody has a residual symptom from COVID, they would not be eligible for that policy. So we also have an amazing ability in our medical system to find illness. So I have people who apply who believe with their whole hearts that there is nothing wrong with them. They are not on any medications. They are not tired. They are great, right? But their labs showed that their kidneys are not functioning as well as they should. And there's nothing the doctor can do about it. It's nothing that they may not know about or have any impact for another 15 or 20 years. But long-term care is long-term care. And if the insurance company sees that lab from that doctor, which they will when they look at medical records, they will deny that person based on the fact that they know that that is an indication that in 15 to 20 years, this person is going to be in a lot of trouble or have a higher probability of being in trouble. So the fact that our medical system is so good at finding illness and finding disease is not in our best interest. And so I always tell people, as soon as you say to yourself that I believe that I will be self-sufficient in old age, that is the time to get long-term care insurance or to look into long-term care insurance options so that you can weigh those risks. Because that may be the only opportunity you have. Interestingly, I actually have long-term care insurance on my children. I got it for my son when he was in college, when he started to play football, because I knew as an occupational therapist who worked in spinal cord injury for several years, that young people can have devastating injuries. Now, it's a very, very small percent, but I knew that if I could have a policy on him and something happened, I knew he could be self-sufficient and be taken care of. And so small probability, but high consequence, it made sense for me to do that. So it's really not about age. It's really about what you believe the financial situation will be of a person when they need to care for themselves in old age. I think I hit all of the questions that I had so far. Is there any other questions?
Yeah, great. Thank you, Linda. We do have some wonderful questions coming in. I want to remind everyone you can use the chat feature located at the bottom of your screen to send them in. We did have a question about, are you concerned about rate stability at all?
Good question. So in every industry, when they start, it's difficult to figure out what is real in actuarial terms. So the earliest long-term care policies were wrong in every actuarial definition that they could come up with when they priced that product. Products before 2006 are about 380% underpriced. And that is why you hear about these ravaging rate increases on older policyholders. They expected that there would be an 8% inflation rate of interest. Well, we all know how that went. They expected that 5% of people would drop their long-term care policies. Less than 1% of people drop their long-term care policies. Unlike life insurance and disability, where people can literally outgrow the need for insurance because the kids are grown up and the house is paid off, or they're getting close to retirement and their retirement is pretty good, why pay a premium when they're just going to retire in a few years anyways? Those last few years are the most expensive years in an insurance company's product, because they're the highest risk that somebody would get hurt or die, and they're the very time at which people give up their products. But long-term care is a very different product. The older we are, the greater we appreciate the long-term care product, the greater the value, and less than 1% of people were dropping them. And the last thing they got wrong was they expected about 1 in 4 people would use long-term care. And it's much closer to 1 in 3 with a 90-day elimination period and 1 in 2 for a 0-day elimination period. So everything they could get wrong, they got wrong. The new policies are more than 400% more expensive than those earlier policies. So in terms of rate stability, I absolutely feel that these products are, significantly, is there a chance of, a 10% rate increase over the lifetime of these policies? Yeah, there's a small probability that they could happen, but very, very low probability that I believe that these new products will have rate increases. And I believe that the states are going to be very, very rigid on it too. Most states have rulings that says that if they raise a rate on an existing policyholder after policies later than 2006, then the company has to decrease their profitability across the products. And companies don't want to decrease profitability. So if you look around nationally, there's really no products that have had rate increases since 2006 on those products. I can't think of any.
Okay, good to know. We also had a question about the types of policies. Do you feel that more people purchase traditional policies or hybrid policies?
Yeah, so I'd say it's about equal now. It used to be the traditional policies were really the rage, and they're but I think it's definitely an individual consideration, and what I think is important to think about is what is your need and what is your goal for insurance. You're going to get that big bang for your dollar with the traditional policies, especially couples. So couples will do much, much better in traditional policies. But then again, if you have a significant amount of money, and so you're not really looking because you need it, but because you want it, then the concept of using a hybrid is much more flexible, right? Because you know, even if you pay more for the product, it's leveraging the money and you're getting the cash and the flexibility.
Okay, thank you. There was a question going back to your comment about someone getting lab results back about their kidney issue. So if someone has that, you know, it's going to become an issue 15 to 20 years from now, would they get denied coverage or would their premium be higher?
Good question. So, so everything depends on the stability of a situation. So if somebody's diagnosed with something, there's usually a follow-up. So if they go back in a year and it's stable, then there's potential to get insurance. If they go back in a year and it's getting worse, then no, they're not going to, the likelihood of getting insurance would be very slim. So that's when we would go for annuity products or home care products. And so we'd start going with much lower, much more flexibly underwritten products.
Okay, makes sense. Going back a few slides, you had shared about future value. So I think might have been 2 million as your example. So we're wondering, is that the amount of coverage that you would have from the policy in the future?
So basically what happens is that you pick a number today. So you're picking a daily or a monthly benefit of how much you want the insurance company to pay you today, and an inflation rider on that of how much you want it to grow every year. So some policies, on the traditional policies, usually 3% shows better with a larger number than a smaller number. And on the hybrids, oftentimes, depending on age and gender, I mean, there's just so many things. I always play with the numbers, but sometimes a smaller number with 5% might show better. So we pick those numbers, and then in the future, we can look out as many years as you think it would be before you enter into claim, and we can calculate what that number will be, because they are guaranteed. So if you pick $100 and you expect it to increase 3%, you choose 3% inflation, in 25 years, that 100 is $200. And so, and that's per day. So if you multiply it by 365, you have the amount per year. And if you have 3 years in your policy, then you multiply it by 3, and that would give you your total value in your future.
Okay, makes sense. We had another question about, you know, qualifications of someone who sells long-term care or talks about long-term care. You know, who should folks go to talk about long-term care, and what should their specializations be?
So you know, long-term care is a specialty, right? So I think that it's important to find someone who's going to be independent, who's been doing this for a long time and reads contracts, because it's all about the contract. I mean, glossy folders are nice, but you really want to know what the fine details are. You want to be sure that when you choose a product, it's meeting your needs in the best way. and that it's going to be exactly what you thought it was when you need it. So many financial planners who are not able to sell all products, and many insurance agents can't sell all products. Actually, nobody can sell all products, but some people can show all products. So there's a difference. So independent agents can show and quote on all products, and then you can decide whether you want to buy the products from them or from someone else, that they're ones that they can't sell. But an independent agent will should show, if they're not going to show you everyone's product, then I would suggest that you go to someone who does. So you want to ask, how long have you been in business? Do you read all the contracts? And can you show me a comparison of all the products available in my state, even if you can't sell them?
Okay, got it. We do have a couple other questions that are a little bit more specific to a situation. So I might have you take those conversations offline. So they're a little more personal. So I'm going to skip those for now. But there was an additional question about privacy policies. This is an interesting one these days regarding genetic or genome sequencing.
Yeah, so they're not taking into consideration genetics as of yet. Okay, so life insurance policies can, but the long-term care policies are not taking into consideration your specific genetics. They will take into consideration, some will take into consideration family history. So for example, if you have a parent or a sibling who has dementia, then in some companies you will be limited by the maximum that you can get.
Okay. Like I said, I think the other couple of questions I'm going to have you follow up personally, but I think that answers just about all of our questions. Oh, we did have one earlier and then that I skipped. Someone wanted to know what type of policy you have, Linda.
All right.
Is it a traditional?
Yeah, I have a traditional policy. And I have a traditional policy. I bought it when I was 39 years old because I was working. I just left the nursing home and started in long-term care insurance. And I said to myself, I never want to be in a nursing home. And I figured I had young children, and I figured that the only thing that would destroy the finances of my family was if I got in a car accident or had a significant illness.
Yeah, and I know when we started marketing this webinar, we heard from a few alumni, a doctor in particular, who mentioned, there's been a number of times where you just hear heartbreaking stories of families coming into a hospital and not having long-term care insurance and just seeing what goes on after the fact. So so we really appreciate you taking time to share your expertise with us today. Again, as I mentioned, we are going to send a follow-up email to everyone who participated today, so you'll be able to connect with Linda personally. And I did want to thank everyone for joining us this afternoon. And I am going to throw a quick link in the chat feature. If you want to check out any of our archived webinars on our alumni website, feel free to visit that. But again, I want to thank Linda for spending her afternoon with us. And thank you all for joining us.
Thank you for all coming.
Have a great day, everyone.